All right, let's jump right into this explainer. Today, we're exploring a pretty fascinating collision of two completely different worlds: cutting edge algorithmic efficiency meeting the ancient ethical requirements of Sharia jurisprudence. It's literally where thousands of years of ethical philosophy meet real time data processing. Let's unpack exactly how fintech is completely rewiring the Islamic capital market. Here's a quick roadmap of what we're covering today. First up, the modernization mandate. Then, the ICM tech stack. Next, the algorithmic blind spot. And finally, RegTech and future architecture. Starting with Section 1, the modernization mandate, upgrading the market. We are living through a massive paradigm shift right now. Traditional Islamic capital markets, they've historically relied really heavily on intermediaries, mountains of physical paperwork, and honestly, pretty slow manual Sharia auditing. But bring in fintech and it completely changes the game. We're talking digital automation, smart contracts, instant mobile access, and AI data analytics. Now, fintech is absolutely brilliant at solving for speed. But here's the catch. Complex Sharia compliance is deeply rooted in ethical intent, and you just can't fully automate that at the push of a button. Moving on to Section 2, the ICM tech stack and how capital actually moves today. This lays out the modern lifecycle journey of an investment. You can see how capital progresses super fluidly here. It starts with funding through peer-to-peer networks to really democratize that capital, then moves into structuring via blockchain, onto management with robo-advisors, and finally hits market access through digital trading. And all of this is wrapped up in governance powered by RegTech. Let's break these components down a bit. Think about traditional bank loans. They often block innovative small businesses because of really strict collateral rules. But digital peer-to-peer platforms, they totally bypass those barriers using Islamic structures like musharaka for partnership and mudaraba for profit sharing. This is huge because it directly scales the core ethical goals of Islamic finance, fostering socioeconomic welfare and equitable risk sharing for everyone. Next up in the stack is blockchain. From a tech perspective, this is literally the ultimate trust automator. By using immutable digital ledgers, blockchain completely cuts out the middlemen. It distributes profits instantly, the exact second pre-agreed if-then criteria are met. It is operational efficiency at its absolute finest. But, efficiency is great, but we have to look at the systemic risk on the other side of the scale, and that is algorithmic rigidity. Immutable code simply cannot interpret context. So, if external market circumstances change dramatically, those deployed smart contracts, they can't dynamically adjust to ensure they're still aligned with Islamic principles. If a mistake gets made or a subtle nuance is missed, there's no going back. It is permanently locked into the ledger. Then we'll look at asset management. Robo-advisors are doing a great job democratizing portfolios for retail investors with low-cost, automated allocation. But imagine trusting a piece of code with your life savings. A lack of human interaction can definitely breed skepticism. Plus, any cyber breach of these massive datasets is a direct violation of a foundational Islamic principle called hifz o-mal, which is the absolute protection of wealth. Now, what's really interesting here is market access. These digital platforms eliminate paper delays and give us real-time price discovery, which massively boosts liquidity. However, this exact same real-time access introduces a really severe unintended behavioral risk to the user, something traditional markets never really had to deal with in the same way. That behavioral risk is misir. The gamification, the push notifications, the sheer instant speed of these digital trading apps, they can actually trigger impulsive behaviors that look a whole lot like prohibited speculation or gambling. It demands constant vigilance from us to make sure the technology is actually serving the investor rather than just exploiting their psychological impulses. Which brings us right to Section 3, the algorithmic blind spot, exploring the limits of automated ethics. Take a look at this AI-powered, ESG-style screening funnel. It is a powerhouse. It ingests massive amounts of raw global market data, filtering out riba, meaning interest-bearing assets, along with gharar, which is extreme uncertainty, and any non-halal industries. What drips out at the bottom is this highly curated, perfectly Sharia-compliant gold portfolio, and it does this incredibly fast. But as efficient as it is, we really have to ask ourselves a crucial question about this automated funnel. Does it risk oversimplifying Islamic jurisprudence? Because at its core, Islamic finance inherently requires extensive, qualitative, and deeply context-based human analysis. Here's the thing. AI acts as a fantastic detection engine, scanning perfectly against established standards. But when the external market environment abruptly shifts, the code hits what we call an intent misalignment blind spot. The technology literally cannot see the nuance. That is the exact moment you need human scholar intervention to evaluate the deeper intent, the maqasid al-sharia, and manually tweak those parameters. This diagnostic matrix does a great job summarizing the ecosystem's risk. You'll notice domains like blockchain and digital trading carry rigid coding and speculative risks, meaning they absolutely require a high level of Sharia oversight compared to some of the other functions. Basically, the required oversight scales directly with the systemic risk that the specific technology introduces. All right, let's head into our final section, RegTech and Future Architecture, focusing on the human-machine synthesis. Regulatory technology, or RegTech, acts like an automated shield for the entire market. It heavily lowers the cost and the burden of navigating complex regulations. But more importantly, it replaces those slow, manual financial transaction reviews with AI and data analytics to instantly flag non-compliant activities. It's using machine learning for real-time risk management and early anomaly detection, essentially preventing both reputational damage and financial loss before it happens. Imagine a core transaction, let's say a sukuk transfer, sitting right there in the middle. The RegTech layer uses AI and big data to run a 360-degree scan around that transaction, looking for any anomalies. It then sends these automated, perfectly clean reports directly to regulatory bodies, which ensures continuous, unbroken market integrity. Ultimately, we hit a hard boundary. Fintech perfectly optimizes rules through if-then statements, and it scales efficiency like nothing else. But there is a nuanced ceiling. Above that ceiling, that's the domain of scholars, because only humans can truly interpret ethical intent. So the future architecture of this market requires a perfect balancing act, merging that real-time digital screening with mandatory, highly adaptable human oversight checkpoints. Which leaves us with this really defining thought. Fintech transforms how capital moves, but Sharia principles dictate why it moves. You see, the true potential of this market doesn't lie in replacing humans with technology. It's about utilizing AI as a tireless detection engine, while firmly keeping qualified human scholars at the ethical steering wheel. So as we continue to heavily automate the financial world, we have to ask ourselves, how do we ensure our technology remains smart enough to execute, but humble enough to be guided by human ethics? Thanks for joining me on this explainer. I hope this helped map out the future of this incredible market for you.